Good morning, ladies and gentlemen. Well, here we are back to positive, i.e., neutral, buy dividend stocks or add to short maturity bonds. Makes perfect sense. We are now at the same level as we were when we embarked on this silly episode with the coronavirus, and that is about the 20 something of May of February. Here we are. Let's have a look. The 24th of February, when we were at the same score. So basically we have negated everything that's happened since the 24th of February, and to me that makes perfect sense. Now, is this the time to get bullish? I think not, and I will now give you my case and you can judge for yourselves. I think the risk reward at these levels is pretty awful, and we probably need a decent pullback to be able to sustain the trend towards the latter part of the year. I am now officially turning neutral to bearish for a retracement, but I'm in no way bearish on the market. Now, some time ago, in March, I showed you these calculations which I did to myself, and I told you that how I viewed this was basically as a yield to maturity of the market. I said that if this episode is transitory, and let's face it, all pandemics are transitory, all you have to do is work out how long before we go back to full forward earnings, and then put in a multiple and it'll give you the current yield of the market. And this is the calculation I came up with when the market was at 2770, and I had a yield of nearly double figures, and I said this has got to be a buy. Okay, well, now let's see what this tells us. Let's say that we have another year to go, approximately, till we are back to full forward earnings of 160, which seems to be what everybody is saying. Now, if we have a multiple of, say, 20, well, let's make it 21, okay, because the bond yields are lower. Current price is 3,200. Here we are back below 5%. If we put this multiple down to 20, we are exactly in line. We have a current yield of 0. So now the only question is what is the right level for multiples? To me, I think no way is 15 the right level. 17, 18 is neutral. 20 is getting bullish. 22 is getting very, very, very toppy. That will give you a terminal forward price of 3,520. But I would say that at the moment 20 is a perfectly reasonable multiple to have or to expect, because we do still have many risks. The risks are, do we have a second wave? There are so many risks here that to pay more than 20 for the multiple is, I don't know, very, very risky. Could the market go to 22? Yes, it could, but I don't think it will anytime soon. Could this be 170? Absolutely. And let's put it in at multiple of 20. That gives us 3,400, and we are at 3,200. Now, does this show you that there is still further potential upside from here? Absolutely, but I think at the moment, with the current risks that we have, with the US election, with everything that is going on in the world, with the China tensions, this multiple really shouldn't be much more than 20, and this could be even as low as 150. Okay, so we have risk reward is not on our side. I don't think we could be anywhere in the range between -6, -7, and +5. Risk reward is now, it's stating the obvious, it's nowhere near as good as it was at 27.70 when it was double figures, and I could see no reason not to be long of this market. Now I'm seeing many reasons not to be long of this market at 3200 right now. That does not mean it's not going to go much higher later on, but right now the risk reward. And what are deviations telling us? Deviations are telling us that technically that is exactly where we are. We are in the wrong risk reward level. Just like you should have been buying it all the way down here, you are now selling it all the way. If we look at the sectors, you will see that a lot of them are in the red. The only ones that aren't are things like XLU and XLV, which led a long time ago and have been basically going sideways for weeks, if not months. XLB, it's getting to all-time highs, and XLK is probably the one that has the most room at the moment, but I even don't think that that one can do very much. And I will show you later while technicals are so bad. And have a look at XLF. Last week I told you that if the market was going to go substantially higher, XLF has to lead it and the yield curve has to show it. That is precisely what has happened. But now its risk reward at these levels is all wrong. If we have a look at other sectors like XLY, they're also getting extremely overbought. I wouldn't want to be long of anything, including XLI. I've been telling you XLI and XLF have to lead for this market to go to substantially higher. That is precisely what has happened, but now it's time for a rest and a retrace. I haven't shown you this chart for a long time because I said there's no point. It's going to look stupid. Well, the only reason why I'm showing you this chart is because even though forward earning expectations are turning upwards, it's going to take them a hell of a long time to catch up with the market at this level. Markets anticipate, and then just when you get the proof of the pudding, as it were, which let's call those numbers on Friday the proof of the pudding, i.e. we're going to have recovery, things are going to get better. That is precisely when they stop and they reverse, because all the smart money gets out. It says, well, you buy the rumor, you sell the news. That was the news, and that is precisely where I think the market is now going to stop and go sideways for quite a while, waiting for these blue angels to catch it up. I've been saying for a long time that if the market is going to do substantially better, the yield curve has to steepen. I mean, it makes perfect sense. You have to get people rotating out of the safety of the longer end of the curve, and because the short end, 2 years, is absolutely fixed by the Fed. The Fed is not going to move short-term rates for I mean, certainly for a year. So there is zero danger of the Fed hiking or the Fed doing anything. The Fed will continue buying at the rate they have set, come hell or high water. There is absolutely no reason for the Fed to change anything between now and the election. And that is why I don't think that the retracement is going to be in risk, is going to be too deep, but we're still going to get one. And if you look at the yield curve, that it broke the day before the figures came out, and everybody then piled in. And then at the end of the day, the market actually came back substantially. I got out of all my steepeners right here. I think the risk reward in the 2s, 10s now is not that it breaks this 73 to 75 area, it's that it backs off into the Fed and after the Fed, and comes back down towards the 55, 53 area, and basically meanders here for a while. The risk reward of the curve going through 75 is bad. At the moment it's bad. I see no reason why it would do so. Twos aren't going anywhere, but tens I think will be supported by the Fed. I just can't see them breaking up through 75 in a hurry. If they do, I'll be wrong, and I'll be the first to admit it, and I think that then we are in full risk on. I mean, full risk on. The only reason why bonds would go down in price, up in yield, is because the economy is doing much better than expectations. Expectations now are pretty damn high. I think they are too high. I think people are discounting that we get back to normal far too quickly. And therefore I just can't see the yield curve going through 75. If I'm wrong, I'm wrong, but I think up at these levels, it actually a short is more prudent than a long, but I am neither. I am flat. I would rather wait for it for several weeks to come back towards 53 and then buy it. Another reason why I don't think the yield curve is going to do very much for the time being is because bonds are reaching the top of their trading range in terms of yield, and that's these 22 basis points that we tried so hard so many times to break and always failed. I think at 22 basis points negative, the bond is actually a decent investment. How will we know if this theory is wrong? Because bonds will bust 22. Okay, and stay there for a couple of days, and if it does that, then I'm wrong. But if I'm right and bonds hold at minus 22, and given the fact that we have complete stability now in the yield differential between bonds and 10 years, and actually I can show you that here, you can see how we have gone sideways for such a long period between these two levels, 125 and 101. If that happens and continues to happen, and I can see no reason why it shouldn't, then I think the yield curve does not go any steeper in 2s10s than 75 basis points and actually starts backing off, in which case XLF will get sold off by 3, 4, 5%. XLK will come off a little bit in sympathy, and we can have a 3, 4, 5% retracement in the overall market. And here we have XLI and XLF against SPY. Exactly what I thought would happen has happened. Little bounce off the this 0.79 line and straight through into risk on. Now I would have thought that these levels are going to be very important, and we can come back to test this line and slowly then start going higher. I just cannot see the market doing much better without these sectors getting going up against SPY and leading it. Those were the laggards, the leaders on the way down, and they have to be the leaders on the way up. XLK basically shrugged off the weakness very quickly in early March and said this is rubbish. I don't see why a pandemic has anything to do with the level of innovation that's going to go on for the next X decades. And these sectors now have to start coming back. XLI saying, production is going to go back to normal, and it's going to go back to what it was before the pandemic, and XLF has to say the losses to the banking system from that 1, 2, 3 quarters, whatever it happens to be, of lower production, bankruptcies, etc., is not going to be that bad. So these sectors have to go back to where they came from for the market to be able to sustain going back up towards the 3400 levels. I think these moves are pretty much exhausted for the short term. I think it's much more likely that they slowly retrace before going up later on in the summer or the early autumn. This chart of the 530s is rapidly becoming one of my favorites at this particular juncture. I still think, okay, this is longer term that we get back to this kind of level, 150 basis points differential between 5s and 30s. But first, I think it needs a rest. It needs to come back and retest this 105 level, and then probably go, am I being a pig? Possibly. But I think it's at the moment the risk reward of selling it here to go there, I don't think it's particularly good, simply because I think the Fed is going to try and control this yield curve. They don't want these yields to go much higher than they are. They have plenty of ammunition to stop them, and I think they'll use it. So I think the risk reward here of continuing to be aggressively short, these levels is not good. I think, fives I think are probably as bad as they're going to get. They could rally a little bit. And I think 30s are going to rally quite a bit when the Fed starts buying. They're not going to let the yield curve go out of control just like that. They don't mind. Would they mind the yield curve at 150? No, they wouldn't. But as long as it's very slow and very methodical, I don't think we will hurry down towards this level. This level could be seen by the end of the year, but not very quickly. SPY TLT, well, what a move. It just absolutely broke through this box like it wasn't important. It just went and kept going right at the 200-day moving average. Is it time for a bit of a rest? I hope so. I hope it's time for a little bit of a retracement to test this box. Something like happened here. I think the likelihood that we just continue going higher is not that good. The risk reward is really not there. I think that we are far more likely in terms of risk reward to come back at some stage and test these levels. It's amazing how the market just goes from one level to the next, just gaps. As I told you, these are the very, 32.15 was, this level here where the support was, is right into it. Now, what is the risk reward at this level? It's not that we go gap up and go back up to 33.30 and fill this whole gap. You can see how important this 33.30 level was in this area, and then again this is where we broke down that Monday, and we just never looked back. I think the risk reward here is for certainly, the retest and filling of these gaps on the way down. First one around 31.28, and then even back down towards this 30.28 level. To me, that is the risk reward. I will know. How will I know? I will know because it'll break 32.14 and the yield curve will keep on going. I really don't think it can break 32.14 on a closing basis unless the yield curve helps it. I see no reason why the yield curve would help it at the moment. I think, it's just, I don't see why it would happen. If I'm wrong, I'm wrong, and, I will try and short it against 32.14 and, and expect certainly a retest of 31.28. I really don't see why those numbers on Friday, because all they do is they just bring forward the return to normality by a couple of months, which in terms of what the market is yielding is almost unimportant. But I guess, that psychologically they were a big shock to some people and they had to cover, and we had the rally that we had. But I think that normal people will lighten up at these yields simply because, as I showed you in that Excel sheet, risk reward makes no sense at these levels. It just doesn't. Volatility did precisely what we thought it would do. It just collapsed down towards the very, very important 2272. You should have that level marked. It To me, the risk reward here now is not great. Okay, not great. I think the likelihoods of having 1 to 2 day spikes up towards 30 are far greater than a break of 2272, which holds. Here at 2 percentage points away from 2272, I would much rather be cautious than not. But that is yet another level that will tell us, just like the break of 3214, if we start trading below 2272, the market has got the bit between its teeth and will probably likely keep going. I can't see it. I think the risk reward is all wrong. But it's a question of timing. I'm not saying the market is going to go down and stay down. I'm saying that the market is more likely to take a breather and fill gaps on the downside because the yield level doesn't make sense, and people are getting too optimistic too quickly. But longer term, I see a much higher market into the end of the year and next year. But we do have a lot of bumps in the road. We have the possibility of a second wave, and we have the US election. I think people will not be that keen to buy it at these levels right now. Another couple of charts which tie in with this idea of mine of a retracement, temporary pullback, digestion, whatever you like to call it, is the US dollar. 96.47 is the very important level here that's been marked forever. I think the likelihood now is towards a bounce back up towards the 98.33 level, and this 200-day moving average, which is slowly turning. Makes much more sense, doesn't it? Makes much more sense for a test of the 98, 30, 50 area, basically just to annoy everyone rather than a continuation down. And probably gold and TLT say the same thing. And here we have gold. Now, 1668. 1668, you should be a buyer of calls or whatever you like, but I think the likelihood from 1668 is for a bounce to at least, say, 1735. Okay, so, or even, let's call it 1725. That is the risk reward at 1668. If it starts breaking 1668, there's something very, very wrong going on, and you might get this type of action. I just don't see why it should. I really don't see it. But this is the possibility. That's why I would be a buyer of calls at 1668 for a 60-70 dollar bounce from that level. Here we have TLT. Now, what I would say is that I think that TLT is bound to trade 148.90, this level here, at some stage. Okay, but first I think we have 2 or 3 weeks of stopping out everyone who puked out the TLT, and it might go all the way back up towards the 160 level. Makes more sense to me than just a straight move down to 148.90. Ties in with everything I've been telling you and showing you in the other charts. I would not be short of TLT here and now. I would wait for better levels and I think you will see them at some stage next week, probably after the Fed. I just want to leave you with a weekly chart of the SPX with those levels marked. I just can't see that this is good risk reward. Okay, at this level, I think the risk reward is for 2, 3, 4 weeks of sideways action, probably even much more than that. Why couldn't we do something like this period here? Basically trade between 29.55 and 32.14 for 3-4 months. Makes more sense to me. It's too quick. The yield, as I showed you in that in that Excel sheet, just is not compelling anymore. 3200 is exactly what the what I thought we'd see at some stage. I think it's silly not to get out at these levels, or reduce your risk exposure waiting for better levels. It's the risk reward at these levels is all wrong. I'm not saying we don't go through it. If we go through it, we will know that we will go straight up to 33, 37. Why that would happen, though, is a mystery to me. And I much prefer to be flat here and looking for opportunities to short against 32.14 than looking for a break of 32.14. Probably, as volatility comes down, when we get up to 32.14, it might be a good time to do some kind of a straddle, sell a straddle, which I will decide what that will be in the next few days. But the optionality here at 32.14 becomes very high. I think you're talking about a movement back down to 30.27 at least, or 33.37. So in any case, we are a good 150 points away from either extreme. So anything that tells you, that gives you that kind of optionality, to me is a good trade. I prefer the downside. I'm open to the upside always, but I think that the risk reward is for the downside. DAX and stocks have met and exceeded all their targets. I think here you have very, very good resistance in the DAX, don't you? It shows you that even if it goes eventually higher, like it did here, first it comes lower. In fact, I'm going to put in a line here. I like this level. This is very nice here. Resistance, support, resistance, support. I think that the likelihood is, that we come back to at least 12,450, if not to these levels here, 12,100 at some stage. And here I would have thought the support is going to be now at 32, 34 again. This kind of trading inside this box of let's say minimum 30.85, 32, 34 is more likely than not. It just, you have to play the risk reward, even though I'm much more bullish longer term. Shorter term, the risk reward is for the retracement. Thank you very much indeed, and tweet you on Wednesday as I'm away Monday and Tuesday.